Good day, everyone. Today we're going to talk about financial asset. Our learning objective for this topic is to define a financial asset and give examples, to account for cash and cash equivalent, account for receivables, and account for investments. First, let's define financial instrument. Financial instrument is any contract that gives rise to both financial asset of one entity and the financial liability or equity instrument of another entity. Financial asset is any asset that is cash or an equity instrument of another entity, a contractual right to receive cash or another financial asset from another entity, a contractual right to exchange financial instrument with another entity under conditions that are potentially favorable, or a contract that will or may be settled in entity's own equity instrument. While financial liability is any liability that is a contractual obligation to deliver cash or another financial asset to another entity, a contractual obligation to exchange financial asset or financial liability with another entity under conditions that are potentially unfavorable to the entity, or any contract that will or may be settled in entity's own equity instrument. An entity's instrument is any contract that evidences a residual interest in the asset of entity after deducting all of its liability. Financial instrument may be divided into two types, and these are cash instrument and derivative instrument. Now that we know the meaning of financial instrument, let's now discuss about initial recognition and initial measurement of financial asset. So, a financial asset is recognized when an entity becomes a party to the contractual provisions of the instrument, and they are initially measured at fair value plus transaction cost, except for the financial assets at fair value through surplus or deficit, whose transactions costs are expensed. Cash and cash equivalent. I have mentioned earlier that financial instrument is divided into two, which are cash instrument and derivative instrument. So cash and cash equivalent is included in cash instrument. So what is cash? Cash is the most liquid type of company's asset. It can be acquired through sales of goods and services, and it can be used as payment or settlement for obligations or liabilities. Cash includes check, cash in hand, cash in bank, and cash treasury account. So there are times that these checks that are used for payments are not yet released. So these checks are called unreleased checks. Released checks are checks drawn but not yet given to payees as of the end of the period. So instead of recognizing it as payment for liability, unreleased checks is reverted back to cash. So our adjusted entry for that is debit cash in bank local currency current, and credit accounts payable or any other liability account. So next is cancelled checks. So these are checks that are cancelled when they become stale, voided, or spoiled. So cancelled checks are reverted back to cash, like the unreleased checks. So our adjustment entry for cancelled checks is the following. So if cancelled checks pertains to current year, our journal entry for that is debit cash modified disbursement system or MDS regular, then credit accounts payable to recognize the cancellation of stale, voided, or spoiled MDS checks. If the cancelled checks pertains to prior period, then our journal entry for that is debit accumulated surplus or deficit, then credit accounts payable to recognize the cancellation of stale, voided, spoiled MDS checks in prior year. So there are times that expenses of companies or entities are not that material to pay through checks. So there are funds for that, and it is called petty cash fund. So petty cash fund is amount granted to duly designated petty cash fund custodian for payment of authorized petty or miscellaneous expenses which cannot be conveniently paid to through checks. So just like the accounting of uh, by business entities, there are no journal entries made as disbursements are made out of petty cash fund. So journal entries will be made if the petty cash fund is replenished or adjusted at the end of the period for unreplenished expenses. The following are characteristics of petty cash fund of government entities. Number one, it is maintained using impressed system. So what is impressed system? This is system of control of cash which requires that all cash receipts should be deposited intact and all cash disbursement should be made by means of checks. So impressed fund system is usually followed in handling petty cash transaction. Next characteristic is sufficient to defray recurring petty expenses for 1 month. Then third is used for disbursements not exceeding 50,000 per transaction. And last is replenished as soon as disbursement reach at least 75% or as needed. Accounting for cash shortage and overage. The disbursing officer is liable for any cash shortage while any cash overage that he cannot satisfactorily explain to the auditor is forfeited in favor of the government. So cash short or over account is only temporary or suspense account. When financial statements are prepared, the same should be adjusted. So the following entries are example of cash shortage and cash overage. So the first example, debit due from officers and employees, credit, advances 4 or 2, or any appropriate account is to recognize cash shortage of disbursing officer. So the next is cash overage. Debit cash collecting officers, then credit miscellaneous income is to recognize forfeiture of cash overage of disbursing officer. And dishonored checks. So these are checks that are not accepted when presented for payment. For example, is a check returned by bank because of insufficient fund, or it is also called as bonds check. So dishonored checks are recorded in other receivable accounts. The drawer of dishonored check is liable for amount of the check and all penalties resulting from the dishonor without prejudice to his criminal liability for a bonds check. So our journal entries for dishonored check is if the dishonored checks pertains to current year, then our journal entry is debit other receivable, then credit cash treasury or agency deposit regular to recognize the cancellation of current year's deposited collection due to dishonored checks. And if the dishonored checks is pertains to prior year, then our journal entry for that is debit other receivables, then credit accumulated surplus or deficit to recognize cancellation of prior year's deposit collection due to dishonored checks. And if the collection remitted to authorized government depository bank, the journal entry for that for current year is debit other receivables, then credit cash in bank local currency current account. Then if the this owner check pertains to prior year, then our journal entry for that is other receivable, debit, then credit, cash in bank local currency, current account. Bank reconciliation. A bank reconciliation statement is a report that is prepared for the purpose of bringing the balance of cash per records and cash per bank statement into agreement. A bank statement is a report issued by a bank which shows the credit and debit to all depositors' account during the period, as well as accounts accumulated balance. So, a government entities prepare monthly bank reconciliation for each bank accounts it maintains using the adjusted balance method. So, in adjusted balance method, the book balance and the bank balance should be equal. So, in order to get the book balance or the adjusted book balance, we will add the credit memos to book balance, then minus it to debit memos. And in order to get the adjusted bank balance, we will add the deposit in transit to bank balance, then minus outstanding checks. Next is cash equivalents. So cash equivalents are short-term, highly liquid investment that are readily convertible to known amounts of cash and which are subjected to insignificant risks of change in value. So only debt instrument acquired within 3 months before their scheduled maturity can qualify as cash equivalents. So what is the meaning of receivables? Receivables are financial assets that represent a contractual right to receive cash or another financial asset from another entity. For retailers or manufacturers, receivables are classified into trade receivables and non-trade receivables. So non-trade receivables refers to claims arising from sale of merchandise or services in the ordinary course of business. So trade receivables include accounts receivable and notes receivable. So accounts receivable refers to amounts due from customers arising from regular trade and business transactions, not supported by promissory note. Other names of accounts receivable are customers account, trade debtors, and trade account receivables. For notes receivable, note receivable represent claims, usually with interest, for which a formal instrument of credit is used as evidence of debt, such as promissory note. So, notes receivable are those supported by formal promises to pay in form of notes. Then non-trade receivables represent claims arising from sources other than the sale of merchandise or services in the ordinary course of business. Loans receivable. So loans receivable is used in the Bureau of Treasury national government books to recognize loans extended by the national government to government financial institution covered by loan agreements. And last is other receivable, such as interest receivable due from employees, officer, other national government agencies, lease receivables, dividends receivables, and others. So receivables are initially measured at fair value plus transaction cost and subsequently measured at amortized cost. This table represents the categories of financial assets and its measurement. So in first column, you can see the type of financial asset. In second column is the examples. Then third is initial measurement. And fourth is subsequent measurement. So the first type of financial asset is financial asset at fair value through surplus or deficit. So our example for that is investment quoted in stocks or bonds. So initial measurement is fair value, then subsequent measurement is fair value. Changes in fair value are recognized in surplus or deficit. Next type of financial asset is held to maturity. Our example for that is investment in bonds and other debt security to be held until maturity. Our initial measurement is fair value plus transaction cost, and subsequent measurement is amortized cost. Next type of financial asset is loans and receivables. Uh, our example for that is accounts, notes, and loans receivables. Initial measurement is fair value plus transaction cost. Subsequent measurement is amortized cost. And last type of financial asset is available for sale financial asset. So our example for that is investment in stock or bonds not classified under A to C above. Then our initial measurement for that is fair value plus transaction cost, and subsequent measurement is fair value. Changes in fair value are recognized in equity. So investment in unquoted equity instrument whose fair value cannot be reliably measured at are measured at cost. Now we are done discussing the cash instrument. So now let's discuss about a derivative instrument. So a derivative is a financial instrument or other contract that derives its value from the change in value for some or other underlying asset or other instrument. So the characteristic of a derivative is number one, its value changes in response to the change in an underlying. Next is it requires no initial net investment or only for very minimal initial net investment. And lastly is it is settled at a future date. So an underlying is a specified price, rate, or other variables. Example is interest rate, security or commodity price, foreign exchange rate, index of prices or rates. So it is included in scheduled events like payment under contract that may or may not occur. So the very purpose of derivative is the risk management. Risk management is the purpose of identifying the desired level of risk and the actual level of risk and altering the latter to equal the former. So based on the notes to the financial statements for the year and December 31, 2006, in section of accounting policies, the last part of it is derivative financial asset. So derivative financial instrument were used to hedge the exposure to foreign exchange risk from US dollars contribution. So in accordance with its financial risk management policy, the IASC Foundation does not hold or issue derivative financial instrument for trading purposes. Derivative financial instruments were recognized at fair value. The corresponding gains or losses are included in statement of the activities. Hedging is part of derivative. So, what is hedging? Hedging is a method of offsetting a potential financial loss or the structuring of even a transaction to reduce risk involving a financial instrument. So, hedge accounting recognizes the offsetting effects on surplus or deficit of changes in the fair value of the hedging instrument and hedged item. So these are the three hedging relationship. First is fair value hedge, a hedge of the exposure to changes in fair value of a recognized asset or liability, or an unrecognized firm commitment, or an unidentified version of such asset, liability, or firm commitment that is attributable to a particular risk that could affect surplus or deficit. So, an example for that is hedge of exposure to changes in fair value of fixed rate debt as a result of changes in interest rates. So the second hedging relationship is cash flow hedge, a hedge of exposure to variability in cash flows that is attributable to a particular risk associated with recognized asset or liability or highly probable forecast transaction that could affect surplus and deficit. So an example for a cash flow hedge is the use of swap to change floating uh, rate debt to fixed rate debt. And last is hedge of net investment in foreign operation. So a hedging relationship qualifies for hedge accounting if and only if the following conditions are met. First is at inception of the hedge, there is a formal documentation of the hedging relationship and the entity's risk management objective and strategy for undertaking the hedge. That includes identifying the hedging instrument and the related hedge item, the nature of risk being hedged, and how the entity will assess the hedging instrument effectiveness. Next is hedge is expectedly highly effective in achieving offsetting changes in fair value or cash flows attributable to hedge risk. Third is for cash flow hedge, a forecast transaction must be highly probable and in present an exposure to cash flow variation that could ultimately affect reported profit or loss. Fourth is effectiveness of hedge can be reliably measured. And last is hedge is assessed on an ongoing basis and determined to have highly effective throughout the financial reporting period. So, a hedge instrument and hedging item is a component of hedging relationship. Hedging instrument is a designated derivative or a designated non-derivative financial asset or non-derivative financial liability whose fair value or cash flows are expected to offset changes in fair value or cash flows of designated hedge item. While hedge item is an asset, liability, firm commitment, highly probable forecast transaction, or net investment in a foreign operation that exposes that entity to risk of changes in fair value or for future cash flows and is designated as being hedged. So example for hedging instrument is cash, shares, and commodities. So that is all for our financial assets topic. So I hope you learned something from this video. Thank you.